You're watching the market. A stock suddenly spikes, volume explodes, price is shooting upward, your heart rate accelerates, your hands move to your keyboard. You see the momentum, the opportunity, the movement happening right now. You enter the trade, 3 seconds from seeing the spike to being positioned. No analysis, no checklist, no confirmation of your criteria, just pure reaction to movement. 4 minutes later, the spike reverses. You're stopped out. You lost $340 in less than 5 minutes on a trade you took in less than 5 seconds. Sitting there, you feel a familiar mixture of regret and confusion. You know better. You have a trading plan. You have rules. You have a strategy that works when you follow it. But in that moment, when you saw the movement, none of that existed. There was only the impulse, the spike, and your immediate reaction. This pattern has destroyed your consistency more than any other trading psychology problem. You can trade with perfect discipline for days, following your plan meticulously, building your account steadily. Then one impulse trade wipes out days of progress in minutes. And you keep doing it over and over, knowing it's destructive but unable to stop when the impulse strikes. Until you understand the neurological mechanism behind impulse trading and why trying to control it through discipline makes it worse, you'll keep experiencing this cycle of consistency followed by impulsive destruction.
The neuroscience of impulse trading. Here's what's actually happening in your brain when impulses override your trading strategy, and why they're so powerful they can erase years of learned discipline in seconds. Your brain has 2 distinct decision-making systems that operate on completely different timescales. The first system, located primarily in your limbic system and brainstem, processes information and generates action impulses in 100 to 200 milliseconds. This is your fast, reactive, instinctual system. The second system, located in your prefrontal cortex, processes information through analysis, comparison, and deliberation. This system takes 500 to 2,000 milliseconds to generate a response. This is your slow, analytical, strategic system. Here's the critical problem for traders. Market movements activate your fast system first, always. When you see a sudden price spike, your limbic system processes that visual information and generates an action impulse in less than 200 milliseconds. Your prefrontal cortex, where your trading rules and strategy exist, doesn't even begin processing the information until 500 milliseconds. This means your impulse to trade is generated, transmitted to your motor systems, and ready to execute before your analytical brain even starts thinking about whether you should take the trade. Neurological reality 1. Impulse precedes analysis. When you see a trading opportunity, the sequence is always 100 to 200 milliseconds, limbic system generates trade impulse. 300 to 400 milliseconds, motor systems prepare to execute. 500 to 700 milliseconds, prefrontal cortex begins analysis. 800 to 1500 milliseconds, analytical assessment completes. If you're clicking within the first 500 milliseconds of seeing an opportunity, you're clicking before your analytical brain has even started processing the information. You're executing on pure limbic impulse with zero strategic analysis. Neurological reality 2. Impulses are emotionally amplified. Your limbic system doesn't just send a signal saying opportunity detected. It floods your body with neurochemicals that create urgency, excitement, and the feeling that you must act now or lose the opportunity forever. This emotional amplification makes the impulse feel like important market information rather than what it actually is, a fast, crude, emotional reaction to visual stimulation. Your brain tricks you into thinking your impulse is insight when it's just speed. Neurological reality 3. Impulse resistance depletes mental resources. Every impulse you resist requires active use of your prefrontal cortex to override your limbic system's action command. This is cognitively expensive. It depletes what psychologists call ego strength or willpower reserves. If you resist 10 impulses in a trading session, your resistance capacity for the 11th impulse is significantly diminished. This is why you can successfully resist impulses early in your session, but fail later. Your impulse control system fatigues, while your impulse generation system does not. Intermittent reinforcement creates addiction. The cruelest neurological reality is that sometimes impulse trades work. Maybe 1 in 5 or 1 in 10 actually turns profitable. This intermittent reinforcement creates one of the strongest conditioning patterns in neuroscience. Your brain learns impulse, action, occasional massive reward. This is the exact pattern that creates gambling addiction, substance addiction, and behavioral addiction. Impulse trading isn't just a bad habit, it's a neurologically reinforced addiction pattern.
The 5 types of trading impulses. Not all impulses are the same. Different types of trading impulses attack your consistency in distinct ways. Impulse Type 1. Visual trigger impulses. These are impulses generated purely by seeing sudden movement. A price spike, a breakout, a large volume candle. Your visual system detects the movement and your limbic system immediately generates trade now before any analysis occurs. These are the fastest and most common impulses. They feel like you're reacting to opportunity, but you're actually just reacting to visual stimulation. Your brain is responding to the movement itself, not to whether that movement represents a valid setup. Your internal experience. It's moving. Get in now before it's too late. Impulse Type 2. Opportunity loss fear impulses. These impulses are generated by the fear of missing an opportunity. You see a setup developing. It's not quite complete, but it looks like it might run away. Your brain generates an impulse to enter now before you miss it. These impulses feel like strategic urgency. They feel like you're being decisive and quick, but you're actually being reactive and premature. You're trading the fear of missing out, not trading a completed setup. Your internal experience. This could take off any second. If I wait for confirmation, I'll miss the entry. Better to be in now than watch it run without me. Impulse Type 3. Revenge and recovery impulses. These impulses follow losses. You just got stopped out. You feel the pain of the loss. Your brain immediately starts scanning for any setup that might recover the loss. Whatever you see next looks tradable because your limbic system is desperate to eliminate the pain. These are the most dangerous impulses because they're emotionally supercharged. You're not looking for good setups, you're looking for any setup that offers the possibility of making the pain stop. Your internal experience. I need to get that money back. There, that setup. Take it. Recover now. Impulse Type 4. Boredom and stimulation impulses. These impulses occur during periods of market inactivity. You've been watching for hours. Nothing's happening. Your brain is understimulated and seeking engagement. Any minor setup looks tradable because your brain needs action. These impulses disguise themselves as opportunity recognition, but they're actually just your brain trying to create stimulation. You're trading to relieve boredom, not because valid setups exist. Your internal experience. Finally, something happening. It's not perfect, but it's something. Let's take it. I need to be doing something. Impulse Type 5. Confirmation bias impulses. These impulses occur when you have a directional bias about the market. You think it's going up. You're watching for bullish setups. Your brain generates impulses for any price action that could possibly confirm your bias, even if it doesn't meet your criteria. These impulses feel like you're trading your view, but you're actually just seeing what you want to see. Your bias is generating impulses that override your actual strategy requirements. Your internal experience. See, it's moving up like I thought. This confirms my analysis. Get in now before the move accelerates. Meet Yale, the trader who couldn't stop clicking. Yale had been trading for 6 years when he finally measured the devastating impact of his impulse trading. He had developed an excellent strategy through years of work. When he followed it, his win rate was 69% with strong risk-reward ratios. His back-tested returns were consistently profitable. But Yale's actual results were barely break-even. The discrepancy confused him until he started categorizing his trades. He divided his trading journal into 2 categories: strategy trades, where he followed his complete analysis process, and impulse trades, where he entered within 30 seconds of seeing the setup without completing his analysis. Over 6 months, the data was devastating. Strategy trades: count 47 trades, win rate 68%, average risk-reward 2.6 to 1, total profit $8,340. Impulse trades: count 93 trades, win rate 34%, average risk-reward 0.9 to 1, total loss negative $7,820. Yale was taking twice as many impulse trades as strategy trades. His impulse trades were erasing almost all the profit from his strategic trades. He had a winning strategy that produced excellent returns and an impulse problem that destroyed those returns. More devastating, the impulse trades were increasing in frequency. 6 months ago, he averaged 2.3 impulse trades per week. Now he was averaging 4.8 per week. The behavior was accelerating, not improving. Yale realized impulse trading wasn't just a discipline problem, it was an addiction pattern that was progressively getting worse the longer he tried to control it through willpower alone. Inside Yale's mind, the impulse trading sequence. Yale documented his internal experience during a typical impulse trading episode to understand the exact psychological and neurological sequence. The setup: watching and waiting. Wednesday morning, 10:30 a.m. Yale was watching his primary stocks. Market conditions were choppy but showing potential. He'd analyzed several setups, but none met his full criteria yet. He was in proper waiting mode, patient and disciplined. His state: calm, focused, strategic. His prefrontal cortex was in control. He felt good about his discipline. The trigger: visual movement. 10:47 a.m. One of his watched stocks suddenly spiked. Large green candle, volume surge, price shooting upward rapidly. Yale's visual system processed this in 100 milliseconds. His limbic system generated an action impulse by 180 milliseconds. The subjective experience was instantaneous. Movement, breakout, get in. Yale didn't think these words. He didn't have time to think. The impulse was pre-verbal, pre-analytical, pure instinct. The impulse wave, physical sensation. By 200 milliseconds, the impulse hit Yale's body as physical sensation. His heart rate jumped, adrenaline released. His hands moved toward his keyboard without conscious decision. He felt urgency, excitement, opportunity, and fear of missing out, all simultaneously. These weren't thoughts, they were sensations flooding his nervous system. The brief analytical window, 300 to 500 milliseconds. Somewhere between 300 and 500 milliseconds, Yale's prefrontal cortex started receiving information. This was his window for impulse control. But the window was incredibly brief, and his analytical process was slow. His prefrontal cortex tried to activate. Wait, check your criteria. Does this meet? But this analytical process needed at least 700 more milliseconds to complete. Yale didn't have 700 milliseconds. The impulse demanded action now. The rationalization, 500 to 800 milliseconds. Instead of completing analysis, Yale's brain did something faster. It generated instantaneous rationalization. This is a clear breakout. Volume confirms. This meets your criteria. It's obvious. You'll miss it if you wait. Take it. These rationalizations felt like analysis. They felt like strategic thinking. But they were actually just justifications generated by his emotional brain to support the action his limbic system had already decided to take. Real analysis would have revealed the breakout hadn't closed above resistance. Volume was elevated but not extreme, and this was the third false breakout on this stock today. But Yale's brain didn't access this information because analysis takes time and the impulse demanded immediate action. The execution, 900 milliseconds. He clicked. He was in the trade. Total time from visual trigger to execution, less than 1 second. His entire checklist, his complete strategy, all his rules required at least 60 seconds to properly apply. He executed in under 1 second. The moment he clicked, Yale felt a mixture of satisfaction and anxiety. The satisfaction came from taking action, relieving the urgency. The anxiety came from a dim awareness that he just violated his process. The aftermath, immediate regret. Within 5 seconds of entering, Yale's analytical brain fully activated and completed the analysis his impulse had skipped. Wait, this didn't meet your criteria. The breakout wasn't confirmed. You didn't check volume compared to average. You didn't verify the trend context. You just reacted. You did it again. But Yale was already in the position. The impulse had forced the action before his analytical brain could prevent it. Now he had to manage a trade he shouldn't have taken. The consequence: rapid loss. The spike reversed within 3 minutes. Yale's stop was hit. Loss, $340. Total time in the trade, 4 minutes. Total time from impulse to execution, less than 1 second. Yale's internal dialogue after: why do I keep doing this? I know better. I have rules. I have a process. But when I see that movement, it's like everything else disappears. The impulse just takes over.
The anatomy of impulse trading destruction. Yale analyzed his pattern and identified exactly how impulse trading destroyed his consistency. Destruction pattern 1: win rate collapse. Yale's strategy trades had a 68% win rate. His impulse trades had a 34% win rate. Impulse trading cut his win rate in half because impulses don't discriminate between good and bad setups. They respond to stimulation, not to probability. Every impulse trade was essentially a coin flip with negative expectancy. The more impulse trades Yale took, the more his overall results regressed toward randomness. Destruction pattern 2: risk-reward inversion. Strategy trades averaged 2.6 to 1 reward to risk because Yale's strategy was designed to maximize this ratio. Impulse trades averaged 0.9 to 1 because impulses prioritize entry speed over optimal entry price, exit planning, and risk management. Impulse entries were usually late, chasing momentum after the best entry point had passed. Impulse exits were usually premature because the lack of conviction from proper analysis made holding difficult. This inverted the risk-reward ratio from positive to negative expectancy. Destruction pattern 3: consistency destruction. Yale could trade with excellent consistency for days or weeks, then have a single impulse-driven session that wiped out weeks of progress. His equity curve showed steady growth interrupted by sharp drawdowns. Every sharp drawdown corresponded to impulse trading episodes. This destroyed psychological consistency as much as financial consistency. Yale never felt confident in his account because he knew impulse-driven destruction could happen at any moment. Destruction pattern 4: progressive acceleration. The most insidious aspect was that impulse trading accelerated over time. The intermittent reinforcement when impulse trades occasionally worked created stronger neural pathways. Yale's brain was learning that impulses could produce rewards, making future impulses harder to resist. 6 months ago, 2.3 impulse trades per week. Currently, 4.8 impulse trades per week. The behavior was doubling, not improving. Without intervention, Yale projected he'd be taking 9 to 10 impulse trades per week within 6 months, completely destroying any edge from his strategy. Destruction pattern 5: strategy abandonment risk. Perhaps most dangerous was that impulse trading, success, however rare, made Yale question his strategy. When an impulse trade worked, his brain thought, "See, quick decisions work. Maybe your strategy is too slow, too cautious."
This cognitive distortion threatened Yale's commitment to his proven strategy. Impulse trading wasn't just producing bad trades, it was undermining his faith in the systematic approach that actually worked. Yale's transformation, building impulse-resistant systems. Everything changed when Yale stopped trying to control impulses through willpower and started building systems that either blocked impulse execution or extended the time between impulse and action. System 1. The 60-second mandatory pause. Yale's most powerful intervention was simple, a mandatory 60-second pause between identifying a setup and being allowed to enter. He set a physical timer. When he saw a potential trade, he started the timer and could not enter until it completed, no exceptions. This single system addressed the core problem. Impulses demand immediate action. Analysis requires time. The 60-second pause served multiple functions. It allowed his prefrontal cortex time to complete proper analysis. It allowed the initial emotional arousal from the impulse to decrease. It created space for his strategy checklist to be applied. It made impulsive entry literally impossible by adding a time gate. In the first 2 weeks, this system felt agonizing. Yale's impulses screamed at him to enter immediately. The 60-second wait felt like torture. But after the pause, approximately 83% of setups that triggered impulses no longer looked tradable once properly analyzed. System 2. Physical checklist completion requirement. Yale created a physical laminated checklist next to his keyboard. Before any trade entry was allowed, he had to mark each item with a dry erase marker. Does this setup meet criterion 1? Specific technical requirement. Does this setup meet criterion 2? Specific volume requirement. Does this setup meet criterion 3? Specific confirmation requirement. Have I identified my exact entry price? Have I calculated my position size based on my stop? Have I set my stop loss in the platform? Have I identified my profit target? This physical checklist served as an impulse circuit breaker. Completing it required approximately 45 to 90 seconds, which was longer than any impulse could maintain its intensity. By the time Yale finished the checklist, the impulse had usually passed, and he could make a genuine analytical decision. System 3. Trade Entry Logging System. Yale implemented a pre-trade logging requirement. Before any trade entry was allowed, he had to type a brief entry in his journal answering, "Why am I taking this trade? Does it meet all my criteria? What is my exact plan for this trade? Am I feeling an impulse right now, or is this strategic?" This logging took approximately 30 to 60 seconds and served 2 functions. It added more time between impulse and execution, and it created explicit awareness of whether an impulse was driving the decision. Writing, "Yes, I'm feeling an impulse right now," made Yale confront the reality that he was about to make an impulse-driven decision. This awareness often provided enough cognitive friction to prevent execution. System 4. Visual Trigger Elimination. Yale identified that his most frequent impulses came from watching price action on very short time frames. Seeing every tick, every small spike created constant impulse triggers. He reconfigured his charts to remove 1-minute and 5-minute time frames during his active trading. He only watched his strategic time frame, 1-hour charts. This dramatically reduced visual impulse triggers. Price could move significantly on the 1-minute chart, but on the 1-hour chart, it appeared as minor fluctuation. Without the visual stimulus of rapid movement, Yale's impulse generation decreased by approximately 60%. System 5. Impulse Redirection Protocol. When Yale felt a strong impulse that passed the 60-second pause and still felt compelling, he implemented an impulse redirection protocol. Instead of entering immediately, he would save a screenshot of the setup, perform full analysis and document it, set an alert for if the setup continued to develop, walk away for 10 minutes. This allowed him to acknowledge the impulse without acting on it. If the setup was still valid after 10 minutes and met all criteria, he could take it strategically. If it had run away, he had documentation that he could review to see if it was actually a valid missed opportunity or an impulse that would have failed. Over time, Yale discovered that 91% of his impulses were either setups that failed quickly, validating that not taking them was correct, or setups that remained tradable after 10 minutes, allowing strategic entry rather than impulsive entry. System 6. Daily Impulse Limit. Yale implemented a daily impulse limit, maximum one non-strategy trade allowed per day. If he took an impulse trade that didn't meet his full criteria, that was his one allowance for the day. Any additional impulse would be automatically blocked. This limit acknowledged the reality that perfect impulse control might be impossible, but it constrained the damage impulses could create. One impulse trade per day could be absorbed. 5 impulse trades per day destroyed his account. The breakthrough realization. 10 months into his transformation, Yale was watching a stock that suddenly spiked. He felt the familiar impulse, urgent, compelling, demanding immediate action. But instead of fighting it or immediately acting on it, Yale observed it. He noticed the physical sensation of the impulse, the increased heart rate, the hands moving toward the keyboard, the feeling of urgency. And he had a profound realization. This impulse isn't market information, it's just my limbic system reacting to visual stimulation. It feels like urgent insight, but it's just a fast, crude, emotional reaction. The urgency isn't real. The market will still be here in 60 seconds. If this setup is valid, it will still be valid after I analyze it. And if it runs away in 60 seconds, it was never a setup I could have captured with my strategy anyway. Yale started his 60-second timer. By the time it completed, the impulse had passed. He analyzed the setup properly. It didn't meet his criteria. He didn't take the trade. The stock continued higher for 2 minutes, then reversed sharply. If Yale had taken the impulse trade, he would have lost $400. By respecting his system, he avoided the loss entirely. Yale's results, the transformation in numbers. The changes in Yale's results after implementing impulse control systems were dramatic. Before systems, strategy trades 47 over 6 months, plus $8,340. Impulse trades 93 over 6 months, minus $7,820. Net result plus $520 over 6 months, barely profitable despite having winning strategy. Impulse trade frequency accelerating from 2.3 to 4.8 per week. After systems, strategy trades 78 over 6 months, plus $14,230. Impulse trades 11 over 6 months, minus $890. Net result plus $13,340 over 6 months, 25x improvement. Impulse trade frequency decreased to 0.4 per week. Same markets, same core strategy. The only difference was that Yale's systems prevented 88% of his impulse trades from executing, and the impulses that did execute were constrained by position limits and daily maximums.
How to fix your impulse trading. Your action plan. If you recognize this pattern in your trading, here's your systematic approach. Step 1. Quantify your impulse problem. Review your last 100 trades. Mark each as strategy, followed complete analysis process, or impulse, entered within 30 seconds without full analysis. Calculate win rate and profitability for each category separately. Make the damage visible through data. Step 2. Identify your impulse triggers. What visual patterns trigger your impulses most frequently? Sudden spikes, volume surges, breakouts, fast movement? Document your specific triggers so you can anticipate impulse generation. Step 3.
Implement the mandatory pause. Create an absolute rule, 60-second minimum between seeing a setup and being allowed to enter. Use a physical timer, no exceptions. This is your primary impulse defense. Step 4. Build your physical checklist. Create a laminated checklist of your strategy requirements that you must physically mark before any trade. This checklist must take at least 45 seconds to complete properly. Step 5. Remove visual impulse triggers. Eliminate or hide very short time frames that create constant visual stimulation. Only watch the time frame you actually trade on. Reduce the impulse input at its source. Step 6. Implement pre-trade logging. Require yourself to write brief answers to why this trade? Does it meet criteria? Am I feeling impulse? This logging adds time and awareness between impulse and execution. Step 7. Set daily impulse limits. Allow yourself maximum one non-strategy trade per day. If you take one impulse trade, you're done. This constrains damage while acknowledging perfect control may be impossible. Step 8. Track impulse frequency weekly. Document how many impulse trades you take each week. Graph this over time. Your goal is to see this number decrease progressively. If it's increasing, your systems need strengthening.
The fundamental truth about impulse trading. Here's what Yale ultimately learned. You cannot eliminate impulses through willpower. Impulses are generated by fast, automatic brain systems that operate before your conscious control systems even activate. The solution isn't trying to stop impulses. The solution is building systems that prevent impulses from becoming actions. Your brain will generate the impulse to trade. That's neurological reality. But between impulse and action, you can insert time, checklists, logging, and circuit breakers that allow your analytical brain to catch up and make the actual decision. Impulse trading destroys consistency because impulses are random, emotional, reactive. They don't follow your strategy. They don't assess probability. They just respond to stimulation. When you execute on impulses, you're abandoning your edge and trading like a gambler. Your strategy trades work because they're systematic, analytical, and probability-based. Your impulse trades fail because they're none of those things. The solution is building systems that ensure you only execute strategy trades while impulses are acknowledged but not acted upon. Stop trying to control impulses through discipline. Start building systems that make impulse execution impossible, or delay execution long enough that impulses pass before action occurs. Your consistency isn't destroyed by your strategy. It's destroyed by the impulses that override your strategy. Build barriers between impulse and action. That's how impulse trading stops destroying your consistency.